Investors have a lot at their disposal to make tax season much easier. Here's how. It's April, and you know what that means.
It's the most
Tax time! Hi everyone, I'm Marc Lichtenfeld, Chief Income Strategist of the Oxford Club. Welcome to State of the Market, and this week I'm showing you how to structure your investments for tax season. But before we start, this channel is absolutely free to subscribe to, so go ahead and click that button. Go ahead.
Yeah, do it. Do it.
Some of you have probably already filed your taxes and gotten your refunds. Me? I'm more of a file it on April 15th at 11:59 p.m. kind of guy. There is nothing I procrastinate about more than doing my taxes. Right now, I'm literally making a video about doing my taxes instead of doing my taxes. Now, I get that we have to pay taxes. My compound in the woods isn't nearly fortified enough to withstand a standoff with the FBI, but it infuriates me that I, a reasonably intelligent person, cannot figure out on my own how much I owe. It really shouldn't be that hard. Here's how much you made, here's how much you owe. Instead, the process is so convoluted, it single-handedly supports a multi-billion-dollar accounting industry and a multi-dollar YouTube video. This multi-dollar YouTube video where I'm going to show you how to structure your investments to be as tax efficient as possible. There's a few quick things before we start. First, when I mention tax-deferred accounts in this video, I'm referring to any tax-deferred investment account like an IRA, a Roth IRA, a 401k, or even a health savings account known as an HSA. Now, if you have the ability to contribute to a 401k or HSA, you absolutely should. You'll save money and you'll lower your tax obligation for the year and be able to eat and sleep inside when you're over 65. Second, tax-deferred accounts have maximum contribution levels, so you can't put everything in there. Today's tips will show you how to take full advantage of the tax-deferred status instead of stuffing your account with investments that are already pretty tax efficient. With that out of the way, let's get down and dirty with the good stuff. Up first, bonds and other interest-earning investments. Putting investments that earn a significant amount of interest into a tax-deferred account is often a good idea. The reason? Interest is taxed at your ordinary income tax rate, which is almost always going to be higher than the tax rate on dividends or capital gains. The tax rate on dividends and capital gains is 15%, going up to 23.6% if you're raking in that fat stacks, as they say at the IRS. While your ordinary income tax rate will be 22% if you're single, making $41,775 to $89,075, or married, making $83,550 to $178,150. So if you're chilling in that tax bracket, you'll pay 22% tax on bond interest and 15% on dividends. So if you're earning the same amount of income from a bond investment as a dividend-paying stock, you're better off protecting the bond interest from the higher tax rate. Of course, you can include both in a tax-deferred account if you have the room and you don't need the money anytime soon.
Must be nice.
On the other hand, certain stocks do not belong in tax-deferred accounts.
Oh, I have 3 kids and no money. Why can't I have no kids and 3 money?
I'm talking about master limited partnerships, or MLPs.
My little pony, my little pony.
Not those MLPs. MLPs are stocks, often in the oil and gas industry, where you are classified as a fancy pants partner instead of a shareholder. And as a result, you receive distributions from the company and not dividends. Now, this isn't just a matter of semantics. There's a real tangible difference between the two come tax season. You see, distributions from an MLP are usually a return of capital. And as a result, they are not taxed as dividends. Instead, they reduce your cost basis, essentially lowering the purchase price of the investment for tax purposes. So if you bought an MLP at $20 per share and received a $1 per share distribution that was a return of capital, your cost basis would now be $19 per share instead of $20. Now, if that occurred every year for another 4 years, your cost basis would be lowered to $15. And when you sell the stock, you'd owe taxes on a capital gain of $5. For the purpose of today's bumper tax season extravaganza, the important point here is that you pay no tax on those distributions in the year they are received. So if you hold on to an MLP for years and years, you're already benefiting from a tax-deferred income, so there's no point in sticking them in a tax-deferred account. The only benefit of holding MLPs in a tax-deferred account is shielding the capital gains from taxes, but you're better off holding other stocks in there that are not as tax efficient. As such, I suggest holding MLPs in your taxable account. A great roommate for those MLPs would be your international stocks. In the US, the government makes you guess how much taxes you owe and then tells you.
Absolutely.
Wrong.
Most foreign governments, with their common sense and tiny sandwiches, take the taxes out of the dividends before you receive them. Since the IRS isn't supposed to double tax your investments, you get a tax credit for any foreign taxes you've paid, but only if the stock is held in a taxable account. If it's held in a tax-deferred account, you will miss out on the tax credit. You're leaving money on the table. Now, there are a few exceptions to the rule. Canada is too polite to tax your dividends if held in a retirement account, for example.
Sorry!
Now, taxes are confusing. You'd think someone who worked in finance for as long as I have wouldn't be bothered by it. But I've been outsourcing the job to tax pros since I nearly put my foot through my computer in the mid-90s. Now, I put everything in an envelope and let someone else put their computer screen at risk. I recommend working with a tax professional if you have any questions about any of the topics in this multi-dollar YouTube video. For more wealth and income building ideas, be sure to check out my free e-letter, Wealthy Retirement. Just click on the link in the description. I'm Marc Lichtenfeld. Thanks for watching State of the Market.